Even though EV's growth may not live up to expectations, it is still possible that the company will double its profits in the upcoming year. There are a lot of people who are pessimistic about Tesla, and I always like to hear their perspectives to make sure I'm remaining objective. However, some people still believe that the company will make $50 billion in revenue by 2024, or about 3 million vehicles delivered. The most likely scenario for this is if Tesla increases 4680 sales supply and ramps up in Berlin and Texas. But even then, we'll still be well over 500,000 vehicles delivered. Even with the Cybertruck ramping along nicely, I don't really see how Tesla will reach 3 million vehicles delivered in 2024. However, Tesla's increasing output is not the only factor influencing the stock price. Wall Street is also concerned with Tesla's financial performance and level of profit. Moreover, Tesla is more than just an automaker. This month could see the opening of a new Megapack factory and some movement in the energy sector. As of right now, there is criticism of Tesla's demand elasticity, primarily due to the company's price reductions for the S and X and FSD. Of course, the balls always refute this with the standard line that Tesla's goal is to transform the world and Tesla's is to see as many cars as possible driven. Tesla continues to sell every vehicle it produces, almost as if they have been brainwashed into making charitable contributions rather than realizing that they are actually making an investment. We've all heard the same mantra a lot, but it doesn't really mean anything. Even Legacy and Rivian sell every electric vehicle they produce, even if it means losing $100,000 per vehicle. In fact, a large portion of the reason Tesla's stock price is so high is because the company is able to sell every vehicle it produces with a significant profit margin, because the cost of the Tesla EVs is significantly lower than that of every competitor on a like-for-like basis. This argument was originally used to defend Tesla against customers who complained about how expensive a Model Y was. The bulls would respond, but Tesla still sells every car they make despite such high prices. Now the same argument is being used to explain why Tesla does not advertise their vehicles, since demand is there and they sell every vehicle they produce. Tesla's sales would rise as a result of advertising in locations that would inform potential buyers of the advantages of owning an electric vehicle. As a result of the increased demand, Tesla would not need to cut prices and might even be able to raise them. I mean, if GM are able to convince people to buy their cars, then surely Tesla can persuade consumers to go electric. But this is perhaps just short-term thinking. It will be just a temporary boost in profits, and likely the stock price also short-term for perhaps 6 months or so, or maybe 2 years until Tesla is much bigger and has Gen 3 in volume production and made some massive breakthroughs in FSD, so much that the stock will just rally by itself, without any necessary intervention through activities like advertising. And if you want the stock price boosted in the meantime, that's just short-term perspective advertising is a bit like increasing the voting machine for Tesla's stock price, whereas in the long run, it's a weighing machine. And didn't you know it's not good sport to be selling any Tesla shares before 2030? You'll make certain bulls very cross. And I'm sure you know who a few of them are. I mean, how dare you even consider selling any of your shares and doing what you want with your own investment? If you want to be a part of this community, then you need to commit until at least 2030, or you aren't one of us, even if you've been holding for 10 years or so. And up to 20 or 50 times return already, that's not enough. You still have to wait to 10x it one more time anyway, despite so few signs on how Tesla will increase supply and sales. And maybe no push advertising to educate people on EVs. We may still see some great profits on the way. Tesla do have 2 very popular models that nearly sell around 2 million a year collectively, so Tesla is updating these vehicles to increase demand that will increase the price and reduce the cost by finding more efficient ways of producing the cars and making they are a very excellent car. But we are all presuming that the Model 3 and Y revisions will be produced in a less expensive manner. At least that's what Elon has been promising. The new Model Y will look even better and probably go into production in around 9 months. We hope that these new designs will be extremely popular and restore huge profits back to Tesla. We'll see the same thing happen with the Model Y later next year. In any case, if we take the Model Y as an example of what I'm talking about, well, if we use an ASP of 40,000 for the Model Y and a margin on 18, then we have COGS per vehicle of 33,000. And if Tesla can reduce the cost by 10, it becomes about $30,000. Some of the renders we have seen with a similar look to the Highland make it look like a really nice car. Should sufficient demand be generated by the additional amenities and range offered by the redesigned shape, the average selling price, ASP, might rise from $40,000 to $44,000. For example, a 10% increase in price would result in a 33% profit margin. You could see how absurd that is, from 18 to 15. An increase in gross profits, which I was obviously not talking about because the operating margin was only 9.6. If we saw a 15% margin increase, that would mean that the 15% gross margin would practically go into the operating margin, meaning that from 9.6 to about 24.6. We would need to do the exact math to find out. That is about 150% increase in profit. However, that isn't entirely accurate because we would have a higher average share price profit margin as a percentage of a higher price. So that's okay. But what if expenses were only cut by 5% and the car's price only increased by $2,000? That would still mean a 5% increase in margin, which would mean a 50% increase in profits, which is still pretty good, plus additional sales assuming further ramping. However, it doesn't have to stop there either. I've talked about this before, but the fact that Tesla is starting on the Mega Pack factory in Shanghai makes me optimistic about the potential supply of batteries, as new batteries from this new factory will essentially be used in the new Model Y. That's freeing up cells that can be used in Mega Pack factories. We're estimating about 70 giga-hours a year of more sales to go into energy, and if they can generate about $100 gross profit per kilowatt hour, then even if we only increase margin by about 5% for the Model Y and 3, then we still double profits, of course. If margins have increased as much as people think, with cost down 10 and price is perhaps up 10 as well in some markets, then we would triple profits if we include energy. But I'm not as bullish as the vast majority in the community. It seems a little bit too good to be true. Also bear in mind that the Cybertruck is going to be pulling down profits for the most of next year too. So even if this is true, then we still won't actually see them in the financials. But I think once Tesla hit around maybe 6,000 to 7,000 Cybertrucks a month, then it's probably breaking even. Of course, Elon thinks they'll get to 3 times that rate by the end of the year. So if that was also achieved, then of course it will increase profits considerably more again. But as it won't be ramped to that level until the end of the year, then it may not be noticed significantly in the money if all goes according to plan. The Cybertruck could have an incredible margin. We're not quite sure yet. It's difficult to tell. But it should be the highest margin vehicle. If the Cybertruck costs $80,000 for the dual motor before the tax credit, for example, then, when mass-produced, there could be as much as $30,000 in gross profit per vehicle. That is too pricey for the numbers that some are aiming for. Therefore, I hope the dual motor pricing is less than that. $80,000 is certainly on the high side for a twin motor, considering the dual motor was advertised at $50,000. Of course, inflation has already occurred, and Tesla was unaware that they would receive nearly 2 million pre-orders in addition to a $700,000 tax credit. There is still room for some optional extras, so that the price tag will still come under $80,000 for the tax credit threshold anyway. That would put Tesla at over $20 billion in net profit annually, or a ratio of about 40 at today's stock price. Thank you for listening. Please hit the thumbs up and subscribe. 70 to 75,000 is probably about right, so nearly $62,500 after the credit, which isn't too hard off the initial $50,000.